In this video, traders, we're going to look at buying options in the current market environment when they're considered to be expensive. Stay tuned. Hey guys, warm welcome to you. All right, thank you for joining me. Question from a subscriber, viewer says, hey, I think the options are quite expensive at the moment. I want to buy options, whether that's a put option or a call option, but I think they're quite expensive. Is there anything I can do to kind of mitigate that risk, or any kind of ways around this? Even if I think they're expensive, can I still get that directional exposure? So I appreciate all your questions, guys, comments, all that kind of stuff. At the moment, we've got loads of questions and comments coming in, and I'll try and get to as many as I can. And if I get a load that are very similar, I will try and do a video as well to kind of share some knowledge and try and help you out where I can, guys. So appreciate all your support, and I hope that you're managing these conditions well. So this question is like, okay, if you look at the price of options, you could quite easily say they're expensive now, because when you compare it back to, say, 2 months ago, the price of a call option or a put option is dramatically higher. Now that really comes down to the expected volatility that traders assume is going to continue, and of course the supply and demand for the demand for insurance protection for the options. So a lot more buying going on. So we see the price of the options much higher because ultimately people are expecting the moves to be far bigger. Of course, if you're expecting the volatility to be high, the moves to be far bigger, the chances of that strike price being hit becomes far higher. So of course the options got to be higher. So you've got this situation where, okay, you've got high priced options and you can put it down to an increase in the price of volatility. And you've got people also who want to make directional plays. And so like this comment from a subscriber, he said, okay, listen, I want to make a directional play, but I think it's just expensive. So what can I do? So what you want to try to do is to effectively strip out as much as you can the exposure to the volatility component of the option. So you still want to do a directional play, and let's assume that you want to do a directional play and cap his risk as well. Otherwise, he'll probably just do a directional play based on the stock or for whatever reason. So he wants to do a directional play, wants to limit the volatility, the impact of volatility change on his trade. Now, if you just bought a call option, which is you're buying the right but not the obligation to purchase a specific asset at a specific price at a specific point in time in the future. If you're not sure about that kind of stuff, go back. I've done lots of videos, and other people who have done great videos on YouTube covering this kind of stuff. But effectively, you're looking, it's a bullish thesis, you're hoping the market rises, it goes up, and then you can either sell the option or you can take delivery of the stock, and the value of the option is going to be expiry, difference between the strike price and the current price. Simple enough stuff, but the issue you have is that, as if you paid a lot for the option, let's say the volatility is really high, it's a really expensive option, then to make money, the price, the actual expiry price has got to be so much further than the strike price to cover that premium you've paid for the option. And so even if you're right, if the volatility starts to die down a little bit, or the market doesn't start to move, it's going to be much harder to make money. So if you're trading something like that, but you want to strip out volatility, let's look at something very simple, a way to do it. Now, there's multiple ways of doing it, stripping out volatility, and there's also multiple ways of just exposing yourself to short volatility or long volatility. But if you wanted to play a directional play on an asset, you could do something like a bull call spread. So in other words, what you're doing here is you're buying a one call, or however many numbers, the same number of calls at the price of A, and you're selling the same number of calls at the price of B. So what this is basically doing is saying, okay, I'm capping my loss, as I would normally do if I'm buying an option, because the option can only go to zero, but I'm also capping my gain here, because actually I'm selling a call. So if it goes past that point where I've sold the call, I'm going to lose the same amount for every $1 it moves up as I'm going to gain on the call option I bought at A. So you kind of got this profit graph like this, where as the price starts to go up to B, you're not going to make any more money, but at least your risk is going to be capped. Now, going back to the initial point of the volatility component, Generally speaking, I know someone's going in the comments going to say, well, it's not strictly true, and I know there are some little nuances because you're actually on two different strike prices. I get it, but ultimately you've neutralized a lot of the volatility here, and you're pretty much neutral volatility within reason, because if suddenly the volatility spikes massively, then both of these call options are going to spike as well. Yes, there might be some slight differences because of the price, etc., but they're both going to spike in volatility, and so you're going to make on one and lose on the other. And same if there's a complete volatility contraction, then you're going to make on your short call, but you're going to lose on your call, on your long call. Whereas if you were just long the call and you had a sudden volatility contraction, everything just went quiet for a while, you're going to lose a lot more money. Just going to lose money because as the volatility contracts, the price of that call option is going to go down, forgetting about where the strike price is. If you were short the call, for example, and the volatility spiked up, you're going to lose money. So you've neutralized the volatility aspect of this. So if you consider that options, or you think that the options are expensive at the moment, you can play around with different strategies like this. There are kind of multiple other ones as well involving this, where you're buying and selling an option in the same asset, but at different strikes, to neutralize that volatility aspect of the option while still giving you a directional play. So if you were bullish on this, for example, this is a call spread, bull call spread, bullish, expecting a bounce, but you didn't want to have that exposure to volatility, this is the kind of thing you could do, and obviously flip it on its head if you were doing looking for some exposure to the downside. So that's one way of doing it, guys. Yes, options are a really good way of getting involved with the markets. You've got to be so careful though. Being careful about the unlimited risk option strategies out there. What can seem like the trade of a lifetime can seem to be the best possible thing ever. Could just go way further than you expect. Some people were selling volatility on the first spike with naked exposure and no capped risk. Have just been completely decimated. They're just doing stuff which, yes, it's a mean reversion type trade, and of course volatility will mean revert at some point in time, but how far it goes before it does that and how much pain you can take and all this kind of stuff, nobody knows. And this is why it's such a dangerous trade. Short volatility is fine, and everyone was doing it for a long period of time, and it's working for years and years and years, and then you just get one of these events out of nowhere that just does a massive standard deviation move and just cleans out everybody. So just be very careful if you're looking to trade options with unlimited risk. Be careful and mindful of what you're doing. The risk is a lot greater in some strategies than others. Obviously, if you want a cap risk strategy, you want to use something like this, or an iron condor if you're trading against volatility, that kind of stuff. But anyway, loads of research, loads of stuff, loads of great videos on YouTube as well. I've done a few, and hopefully those help. Cheers for your question. Take care. Bye-bye.